Hey everybody, how you doing? Welcome to my channel, Stock Markets with Bruce. I'm your buddy, Uncle Bruce. I'm not at the New York Stock Exchange. You might think I am because it's so real looking behind me, but no, I'm in Palm Desert, California. We're all as well. Look, this week we've had an interesting run on GameStop. That is what this video is about. The question is why GameStop shares could go higher from here. That's my video topic today. Here's the deal. All right, GameStop has had a so-so run lately up until early this week, just before earnings were released. The shares have been on a downward climb, and at one point this past week, the shares were even in the $15 upper $15 range. Most of my viewers love writing stock options, and so they've just been cashing in on the drop of value of GameStop now for months and months. But it doesn't matter to us as option writers. If the shares go up, option writers get richer because their shares are more valuable, and they do rollovers. If the shares level off for a while, options just depreciate in values, which is what option writers love because they sell them at high prices to buy back at cheap prices. And if the stock wants to take a dip, well, we'll take an accelerated depreciation and a combination of all three. Look, let's take a little history lesson here with GameStop quickly. Let's take a look here. Look at this chart. This is a chart that was out earlier this week. It shows from April 2020 until 2020, till now, early 2023. Not quite today, but last week. And you can tell here the pricing from virtually nothing up to about $80 a share. Now, keep in mind, you have to multiply these dollar figures by 4 because the shares had a split, and they did once reach over $320 a share, and they spent a lot of time between 160, which is $40, and up to $60. You can see there for quite a while, most of 2021 to 2022. Most of the time, the shares were $40 to $50 to $60. Look in 1920 into 2022, 1922. Look into 2022, and you can see the big drop off here going into 2022, and the shares were in the mid 20s to the high, maybe getting up to just over 40 a couple of times, and then by the latter half of 2022, there was the collapse, and down went the shares. To the end of the chart, as you can see on the bottom right. Now, on the very bottom of that chart, the very end of it, what you're not seeing is the fact that the shares this Friday did close at $23.85. So that chart actually is not complete. That little green line should be above the 20 mark. But nonetheless, there is your chart. Now, let's take a look at another chart. This one. This is a chart from MarketWatch. Any of you can go and watch this and see this for yourself. Go to marketwatch.com and you can take a look at these charts. This is a 1-year chart of GameStop. And if you look to the far left, the blue line at the very top of the chart starts to come down. That is the stock price of the shares from March, April of last year into May, into June. And then in June, July, August, the shares marched their way higher, topping just over $40 a share and then dropping off into the latter part of August. And we've had this slide from August to September, kind of got flat for October, November, then dropped in December with tax loss selling, a little rally in January, and then another drop into March just last week, a couple days ago. And then at the very end, you see the little uptick. Now, look at those triangles. Those little black triangles you see there. The first one on the far left is the earnings report that came out, I guess, around the end of May, June of last year. Then there is a little square box that says the letter S in it. What does that mean? That is the day that the shares split 4 for 1. So prior to that little box there around August, July, August, that little S box, prior to that, the shares were 4 times more expensive to buy and sell. So a $30 price was really a $120 price. $40 price was $120, and so on. After the letter S there, that little X box, around August 1, we were what we call post-split. Now, the other thing I want you to notice is on the bottom of the chart are those little black lines that go along, and they're pretty aggressive at the far left. And then what would it be, by August, September, notice those little black lines almost disappeared. There's just very little activity until right over to the far right. You can look at this week, look at the volume this week. All of a sudden, we've had some pops up here. You can see the other earnings reports that came out. There was one between August and September. There was an earnings report between November and December. And then the last triangle on the far right at the very top was the earnings report that came out this week. And that is the pop we're talking about. Let me now show you this chart. This is chart day. Here we go. It's the same stock. It is now just a 1 month chart. So the blue line going across, you can see how it went. It was under $20 a share. It got down to 17 and a half, March 9th or something like that. Then it dropped even lower. You can see it getting closer to the 15 level. And then just before the earnings came out, for a couple of days there, day and a half, the shares went from the upper 15s through 17 and a half. And then on the earnings day itself, look at that. Boom, we opened up at 20, as high as 27, but we ended up around this 22, 23 neighborhood. A little dip on the day before yesterday. And then yesterday, Friday, which was Friday, March 24th, 2023, we popped up again to close at $23.98 during the session, up $1.40. The after hours lost 13 cents to $23.85. All right. There's a little history for you, and recent history of what GameStop has done as far as pricing goes, volumes go, that kind of thing. Why is it possible that GameStop shares could go higher now rather than lower? And I'm not talking about going like up $5 a day like we used to in the old days, up $20 every day before the split. I'm not counting on that. What I'm wondering about is it possible that the shares of GameStop will not go back to $15, $16 a share for quite some time? Is it possible that that neighborhood might not be revisited at the moment? There's a couple of reasons why things are moving in the right direction for GameStop. The one is this headline that I saw just, I think it was day before yesterday or yesterday. Check this out. This was a headline. Hedge fund manager Whitney Tilson drops this meme stock from his dirty dozen list, quote unquote. I have to tip my hat to management. This is written by, it looks like Shanthi Rexaline from Benzinga, a Benzinga editor. This is an article that appeared all over the place. And more reports and more commentary is coming out on GameStop, kind of like this. It's not full-blown endorsement, but it's certainly an acknowledgement. Maybe that's the way to say it. It's an acknowledgement of a job well done by the company in the last quarter, the fourth quarter, which was September or October, November, December of 2022. The company managed to take their asset base, $915 million of inventory, and they were able to drop that down to $600 and something like $80 million. They dropped their inventory levels dramatically, which is, in effect, recovering capital from inside the business, turning inventory into cash and adding cash to their balance sheet. And their cash flows improved, and they earned a profit of $41 million, I think it was, in the fourth quarter. First profit since 2021 recorded by the company. But more importantly, the profit earned by the company, this isn't like it doesn't look like it's a one-off. It doesn't look like, oh, this is just an accounting trick to make them money, because along with the dramatic drop in inventory levels, they also cut back expenses. They started laying off excess employees last summer, way ahead of Wall Street's darlings that are out there. All the stocks you hear about right now, all the FANG stocks and other companies out there who are announcing layoffs like crazy. These guys are only just coming to the party. GameStop has been ahead of this curve by at least 6 months. They've also closed underperforming stores. We know about that. Every time a store lease comes up, remember, they used to have 5,000 stores around the world. Now they're at 4,000 something. Every time a lease comes up, they've already figured out in advance, probably in the year prior, are we going to keep this store? or are we going to let this store stay closed? Once the lease dies, we can leave, and there's no penalty to leave the mall once the lease is over, rather than trying to negotiate a way out with a year to go. Just wait the year and then walk. They've done a lot of walking from underperforming locations. And each year, I would guess about 1/5 of all their stores roughly are coming up for a renewal. Usually they'll sign 5-year deals. Sometimes they'll sign 7 and 10-year leases. The very worst case scenario, 1/10 of all stores are up for renegotiation every calendar year. Well, or every year on the lease. Look, if it's 1/10, that means 400 stores a year have to be decided upon. If it's up to 1/5, that means 800 stores a year have to be, decided whether to be remaining open or not. So these guys have been shutting down stores that are money losers and are not performing as before because demographics have changed. Shopping malls, as you well know out there, are closing or are evolving into different properties as time goes by. Many shopping malls used to be all about retail. Now many shopping malls are becoming medical centers, law offices, accounting locations, more services rather than retail. And GameStop is not going to be involved in a mall that is catering to tax problems, dental issues, medical issues. They're going to be in a retail environment where the kids are. And so they'll shut stores down and open elsewhere. Perhaps they are also thinking, we'll open stores instead in other parts of town where we shut down this mall location that's not performing anymore. We'll open up in a strip mall where there's a lot of fast food restaurants in the area, where our demographic shops and hangs out. We'll be near a Costco, we'll be near a Winners, we'll be near a Home Depot, we'll be near high traffic, big ticket outfits. But we'll have a store of 1,000 square feet that'll run us 1/3 the rent than we're paying in a shopping mall. Smart. This is Ryan Cohen and his team analyzing every single store. So what they're doing here is they are reducing the cost of being GameStop, being a GameStop corporation. This is very smart business. They have a brand name, they have brand recognition, they have client loyalty, they have 50 plus million people part of their website. They are now setting up their online business. They're really developing that, and they're shifting into collectibles away from just gaming only. All these moves added up have an effect of making the business a much more higher margin business. This is what killed Blockbuster. This is what has killed other retailers, where margins keep getting shrunk and shrunk and shrunk, and you have to sell more merchandise to make just as much money as last year. In the case of GameStop, if they sell just as much merchandise today, which they seem to be doing from last year, their margins per dollar coming in the front door are higher. They get to keep more pennies per dollar coming in the cash register. And then you have a $6 billion cash flow business, $6 billion in sales, $500 million a week on average. We know 3 months in the Christmas season is their heaviest months, and then whatever. But every time new games come out, there's a lineup of people wanting to get into the store to buy the new games, like the new Harry Potter game. These guys have got good traffic flow all year round. And with higher margin merchandise being added, this, on top of knocking off costs, has really turned the game around. So what have they got now that they don't have before? Management credibility. They've got credibility in management. Remember, 2 years ago, we're looking at this chart again. Remember this chart? Look, prior to 2021, before anything happened, when the stock was dead as a doornail down there, April 20, look at that, it was worth nothing. I remember when these shares were trading between $2.70 and about $6 a share for 5 years. It was doing nothing. But at that time, the management of GameStop were still living high off the hog. They had a corporate jet. They had their own company jet that they had access to. Now, some people will say, well, Bruce, the jet was 8-10 years old. It wasn't like an $80 million plane. I'll grant you that. But the reality is that every hour you fly that thing, you have fuel costs, you have pilots, you have staff on board, you have the maintenance of the jet in the meantime. That's the problem with business jets, is to keep them is incredibly expensive and to operate them. And this company was wasting money. They were losing money and were flying management around in private jets. ridiculous. Ryan Cohen got rid of that. He got rid of the highest paid top 10 executives collectively who are probably hauling in. I bet you the top 10 executives were hauling in 15 million a year in salaries, maybe 20 million a year. He got rid of all those guys. They walked with some stock and what have you, but he got rid of them. And he's replaced this top 10 management with a far hungrier group of people, far more in tune with the business that they're into. And they're getting a fraction of the upfront money that these former managers used to get. The former managers were not incentivized to make money for the company. They were incentivized to just hang on to their jobs and enjoy life because they were really raking in some nice bucks. Not anymore. Now you have to perform. And so the company made $40 million. They've cut their costs. They're increasing their margins. They've got street cred among some people in the business. What you haven't seen yet, and it might take another couple of quarters, but you've not seen Wall Street analysts jump on board the bandwagon to say, yeah, these guys are for real. We recommend you buy the stock. Even this particular quote here, you read this story, this hedge fund manager is not recommending the stock as a buy. It's not a buy, but it's not a short. Don't dare short this stock anymore, because if you short this stock, you are taking your life in your hands. And that is the first stage of a massive turnaround in the company's imagery and thought process when it comes to investors. Fair enough. Now, look, if they make $40 million a quarter for the next 3 quarters, then they'll have had an entire year of making money. They'll have made $160 million. Again, this is all theoretical. They'll have made $160 million in profit. There are over 305 million shares in existence. So if you take 300 plus million shares and divide that with 160 million in profits, it's going to be about 55 cents a share profit, maybe something like that. $1 a share profit, they'd have to make 305 million profit. All right, to give you an idea. 10 cents a share, they have to make 30 million a year in profit. So they're on their way to 55 cents, maybe 60 cents in profits, if they can maintain these kinds of profits. I don't know if they can. It's possible, but if it comes out at 50 cents a share, let's say, even at $24 a share now, the shares right at the moment are trading between 45 and 50 times earnings, which is too high. So technically, and on a basic financial level, they're too expensive. However, if the thinking inside the corporation and observers just outside the corporation, the thinking is that this trend is going to accelerate, that these cost savings have only just started to kick in, and that they will continue to reduce underperforming stores, reduce staff levels, improve margins overall, keep reducing inventory on hand, get it from 600 million to 400 million, perhaps work deals with their online sales where they don't pay for merchandise until they sell it, and they can return unsold merchandise that doesn't sell. You play that game, you are going to reduce your capital involvement with regards to inventories. You're going to still improve margins if you're getting top dollar for your merchandise. Perhaps they can push it to 50 million a quarter, 60 million a quarter, and come out, say, a year and a half from now, the thinking might be, gee, Bruce, they're not going to make 50 cents a share in a year or two. They're going to make 70 cents a share, and then they're going to make 90 cents a share, and then they're going to make $1.20 a share because they're going to keep evolving their business. If the thinking is of that nature, then the forward price earnings multiple number will be analyzed very closely, and there will be some analysts who might come out and say, they're trading at 50 times earnings now, but they are only trading at 20 times future earnings 2 years from now, based on estimates. That's how a stock can trade at a high P multiple today, based on the future revenue that can come in. Something that GameStop has not had any discussion about anywhere. This has not been talked about by anyone anywhere for years. And so maybe, just maybe, the shares won't go back to the $15, $16, $17 level, because those in the know, or those with longer term outlooks, are going to go, hey, I've written this paper out in and out over the years. I'm going to keep holding this paper. My viewers are thinking, I'm going to hold this paper no matter what, because I'm writing options on this stuff and I'm taking in option premium. thank you very much for allowing me to be a shareholder of this company. By going to Bruce's website right here, I have figured out how to write options because I just click on that options link and I started taking these classes on how to write stock options. I'm even sitting here with deep in the money call options. Lesson number 11 is my favorite lesson. I use deep in the money options, these $5 and $10 contracts that I'm buying for Jan 2025, and I am writing calls against my call options, giving me way more leverage. And I've understood how the 90-10 rule works. I understand what stink bids are, stink offers. I understand the psychology of the market because of Bruce's channel and his website. That is what's been happening here. By the way, you can join me live every day, Monday to Friday, during market trading days, 8:30 a.m. Eastern time for 2 hours every day for updates on what's going on in the stock market in plain English. I invite you to join us. You'll find that a whole bunch of folks comment during the show. During the markets, only people allowed to comment on my channel are members of the channel. We try to keep trolls out, and we keep it PG rated. So if you have young ones around the house, fear not. We try to keep things on the upper level. Thank you for joining me today. Let's keep an eye on GameStop this week and next week. Congratulations to all of you option writers out there who've been making some real nice money on GameStop, and you will make a bunch more going forward. In the meantime, thank you for joining me today. Please subscribe to the channel if you don't mind, and give this video a thumbs up if you like it. We'll talk to you next time, everybody. You take care. Bye for now.